Okay. Thanks for everyone for joining us today. So we are going to be talking about our short-term rental tax and compliance for the US side. And then this is a three-part series. So I know that some of you have registered for just this specific one, but we have a three-part. So this is part one, where we are actually meeting with our friends over at Keystone, and they're going to help talk us through short-term rental tax and compliance. So just walking through before we get started, there's our normal disclaimer as mentioned. And then quickly to introduce myself, as I've talked with many of you, my name is Brandon. I am the accountant in residence here at Hospitable, doing all things accounting and QuickBooks integration, tax, compliance, and so much more. And so, as I mentioned, this is part of our three-part series. So this is part one, and then you have seen likely this in the community and posted out. But kind of just high level, what we're going to be talking about today is different areas of short-term rental and the tax and compliance pieces of real estate and all the different things that actually fall into that. And so, just quickly, if you have any questions, please feel free to put them in the chat, and I'll save them for Q&A at the end, because we are going to have some time for that if you have anything specific. So if you run into anything, we can definitely answer it as part of it. So I will bring Matt and Amanda on, and they can kind of quickly introduce themselves, and then we can get started from there.
Thanks for having us, Brandon. It's great to be here.
Yeah, super excited to be here, and so amazing to meet all of you guys. We were just chatting this morning about how excited we are to be here today, because this is actually our favorite audience profile. You guys are in short-term rental space, using automation, using the platform. So a lot of really amazing things that we can do when it comes to tax strategies. So yeah, like Brandon said, today's all about tax saving strategies.
Yeah, and again, I'm Matt MacFarland. This is Amanda Hahn. We're with Keystone CPA. Our firm specializes in working with real estate investors all over the country to help them with proactive tax planning and help them keep more of their hard-earned money, obviously.
Yes. Yep. So you might have seen us speak. We teach all over the U.S. on tax strategy for real estate investors, and you might have heard us on podcasts. I think this is our second year now coming back with Hospitable, and I'm super excited to be sharing the different things that we can look out for. I don't know if you guys can see Matt's face or if he's kind of cut off a little bit, but so in any case, one of the things we want to make sure we touch on today as we head into tax season is what are the different things we should be doing before we meet with our accountants who are going to be filing our tax returns. We're going to share some common mistakes that we see this time of the year, and we're going to talk a little bit about ways to avoid those common mistakes, and then we're going to share a client case study on just the tax power of short-term rental investing when we're using the short-term rental tax loophole. So pretty ambitious agenda for today.
Yeah, but I think it's going to be good. Obviously, it's a crucial time of year, and everyone's favorite topic is taxes, right? So excited to be here and give you guys some good nuggets today.
Yes.
So I think one of the things that came out recently was the One Big Beautiful Bill. It came out in the middle of last year. Probably one of the biggest tax changes in recent history with respect to all-encompassing, actually, because it deals with real estate investors, deals with individuals, deals with business owners. So goodies kind of for everybody. But we're here. I think one of the biggest benefits that came out of the One Big Beautiful Bill was 100% bonus depreciation. I think real estate investors' favorite topic, right, is depreciation. And so for 2025, and a great thing about this was that it made it permanent going forward, as it's going to apply in 2026 as well, is that for assets you put in service after January 19, 2025, if they're eligible for bonus depreciation, you're going to get 100% bonus depreciation instead of 40% or 20% like you would have done. So more than doubling the benefit that you're originally going to get prior to the One Big Beautiful Bill.
Yeah, and what's really interesting is that the 100% bonus depreciation applies to all of you who bought rental real estate after that January 19th date in 2025. So like Matt said, it's for those of you who did that, when you're about to file now your 2025 tax returns, make sure that is something you take advantage of. Now, some of you may have owned rental properties prior to 2025 that you purchased beforehand. Keep in mind that although the building itself is not eligible for 100% bonus depreciation, we can take bonus depreciation on, or we can take 100% bonus on any improvements that were made during 2025. So, I know a lot of short-term rental operators, it's not just about buying the property, but you also try to, improve it so that you can charge the highest rents possible. So to the extent you have done improvements in 2025, make sure you take advantage of 100% bonus depreciation. Now, that, this time of the year, what we're typically doing is we're getting ready to file our taxes. And something really interesting that I just learned is that Forbes came out with a research that said over 93% of entrepreneurs overpay in taxes. Isn't that crazy?
Let that sink in, right?
And now, to be honest, I don't know if by entrepreneurs they include real estate investors or not, but it is still pretty shocking. One of the things that we do when we work with investors all over the US on tax planning, the first step of planning is we look at their previous year's tax returns. Why? Because it tells us a lot about what they own, how they reported things, if there are missed opportunities. And for us internally, a little over 40% of tax returns we review are not optimized for tax savings. And that means there are opportunities that could have been utilized to reduce taxable income. And because it's now the beginning of tax season, what we wanted to do is to spend a good chunk of our time together to go over some of those common mistakes we see when we're reviewing those tax returns. And the hope is that you will be able to avoid a lot of these common mistakes. And then obviously we're focusing today on, in the short-term rental realm. Okay. So let's get started first. Our most common mistake that we see with respect to tax filing time are missed tax deductions.
Yeah, and this happens for various reasons, right? People just don't know what to write off. They forgot about what they spent money on. They don't have good records, good books, good financial statements, all various reasons, right? But this is one of the most common overlooked areas we see with respect to deduction. It's just overall deductions, right? So real estate investors, you guys are good at capturing the expenses that are related to property, specific to properties, right? Mortgage interest, property taxes, insurance. Those are things people capture. They don't forget about those. But
well, I will say we do see insurance missed quite a bit. I don't know if it's because, it's impounded but that is an item that for sure all short-term rental investors have. So do make sure you capture that as well.
But the things that come to mind, front of mind, are those other, we call them overhead costs of being a real estate investor, being a business owner. So travel costs, going to conferences, dues and subscriptions, software, things like that aren't tied specifically to a property, but you are spending money on them, right? So travel's a big one. We go to conferences all the time where we see people, clients, and we talk to them later on, getting ready to do their tax returns. Hey, I noticed your travel expenses are very nominal, or if anything. I know I saw you at this conference, right? I know you spent a couple $1,000s because we did too, right? So where's that deduction, right?
Yeah. So I think just really, as an investor, you are the first line of defense when it comes to maximizing write-offs. And the reason that is because if you are not tracking your expenses, then there's almost 100% certainty that your accountant is not going to write it off. Why? Because they're not with you day in and day out. And so to the extent that you have these business expenses, make sure you track them. They are deductible regardless of whether you have an LLC or not. So if you own your short-term rental in an LLC, great. But even if you don't, you can still take all the same tax deductions that are available to any other real estate investor who has an LLC. Some common ones we see missed quite a bit is home office deduction. Most short-term rental operators do not rent an office just to manage their own properties. So to the extent you have an eligible home office, make sure you're taking it. It is not a high audit risk. It has not been for many, many, many years. If you use your vehicle for your short-term rental business. And the vehicle use is not just limited to me driving to the property, right? There's a lot of other use cases. Even if my properties are out of state, I may still be driving to meet with my accountant, for example, right? To work on my short-term rental taxes. Or I might be going to a bank to meet with lenders and think about refinancing, or maybe I'm having a meal with other real estate investors, right? To talk about partnering. So making sure you claim the business use percentage of your car expense. And again, this is true regardless of whether or not you have an LLC that holds title to your property. The car itself does not need to be titled in the LLC. Even if it's your personal name, you could still write off the business use percentage of your vehicle.
Another great example we see often overlooked is just the example of paying your kids and getting your kids to help you in your business, right? Because we know kids are expensive. We know we're spending lots of money on the kids, but there's a way that if we can hire them in our business, help them do work for you, you pay them, it becomes a deduction to you. It can be tax-free money to them. And this is what we like to call Operation Zero. Because you're paying your kids, say, $6,000, $7,000 a year, you're taking a tax deduction for it. Because they are earning less money than their standard deduction, they don't have to pay income tax on it. But the best part about it actually is they can, now that they have earned income, they can put that money into a Roth IRA. So think about the power of that compounded growth and kind of changing your family legacy. Open a Roth IRA for your kids at 15 or whatever, and at 60, 70 years of tax-free growth. I mean, that's pretty amazing.
Yeah. Short-term rentals are really a great tool to get your kids involved, all the time. Right? There's a lot of different things they can do, help you with stocking supplies, helping with getting stuff ready, helping you with, if you're self-managing and it's local to you, so helping you with doing the laundry, right? For doing tenant turnovers and things like that. I mean, a lot of times we do tax planning calls with clients and they're at the property, working on the property, and we'll see kids in the back working, alongside them. So a really great way to say, okay, instead of just giving money to my kids, what are some of the things I can do to legally shift income to them where I can take a tax deduction and they don't have to pay income taxes on that, right? Now, what you pay your kids does have to be reasonable. They have to actually do the work, right? We don't want to start teaching our kids to lie.
We don't want to see them not doing work in the background of that Zoom video or whatever.
Yeah, we're not here to teach our kids to lie to the government, right? And so it's about teaching them good habits, teaching them how to make their money, how do investments work, and pay them a reasonable amount for the things that they're actually doing. And again, the tax benefit is now I am taking a tax deduction for money that I was otherwise just giving to my kids anyway. So before you meet with your accountant, one thing is to make sure you take the time now before that meeting to go through your records and make sure you understand what are all the different things you can write off, right? Not just property specific things, but what are all the other things? Gather them so that you can send them to your accountant when you meet with them. For our clients, we provide them with a tax deductions checklist of over 100 common tax deductible items that are utilized for rental real estate specifically, right? Because that helps them to figure out, okay, what are some of these things that you're talking about? Did I have this? Did I have that? For those of you guys are with us and you want a copy of our 100 plus tax deductions checklist, you can go ahead and send an email probably to me. Email me at ahan@keystonecpa.com. And then I'll be sure to share a copy of that with you guys. Unfortunately, I didn't bring a QR code for that, but send me an email. I'll get that out to you guys.
Cool. Another big area that we see mistakes made a lot is with the wrong legal entities. So as Amanda mentioned earlier, one of the key myths is that people think they need to have a legal entity to take tax write-offs. And again, that is the farthest thing from the truth. You do not need to have a legal entity for the majority of your common write-offs. It's probably a lie, I don't know, propagated by lawyers, maybe accountants for that matter, but you just need to have, in order to take tax deductions, the expense needs to be ordinary and necessary for your line of business. And again, if you're in short-term rentals and maybe another line of business, that answer might be different depending on the line of business. Obviously, it might be different than your next door neighbor or your friend who's doing something else. But again, it just needs to be ordinary and necessary for your business to take tax deductions, and you don't need to have a legal entity. Now, there is a benefit for legal entities. Obviously, for rental properties, we utilize LLCs, the whole title of the rental properties a lot, and that's purely for asset protection reasons. So it's not a tax strategy, it's an asset protection strategy, and definitely one you want to think about doing for yours.
I think on the topic of legal entities, there's sort of a misconception for some reason that because, short-term rentals, if we're using the right strategy, which we'll talk about in the short-term rental loophole, that somehow is treated differently than regular long-term rentals when it comes to entity structuring. So from time to time, we come across short-term rental operators who own their rental properties in an S corporation. And that presents a pretty big problem from a tax perspective.
Yeah, so from a very high level, you don't want to have corporations owning rental properties, whether it's a C corporation or S corporation. The tax problems it can create are it can limit your benefits from the depreciation expense. There's different tax reasons for that. And also, if you ever have to refinance the property down the road, a lot of lenders are going to say, hey, okay, I want you to refinance it. When I refi to you personally, title needs to be held by you personally instead of the corporation. Well, in order to do that, when you change title, that actually can become a taxable event to you just by transferring title from an S corporation to a personal return. So we want to kind of avoid that at all costs. And so again, LLCs that are either taxed as disregarded entities or partnerships are really good for rental properties, just not corporations.
Yeah. It may be okay if you have another entity to kind of be like the manager of it, or if you're co-hosting and you have a corporation that, earns like the co-hosting income, but with respect to the property itself, right? Title holding to the property, generally we don't want that in a corporation. And, unfortunately, it's one of those things that if people inadvertently put it in there, it's sometimes very costly and difficult to unwind. So
For sure.
make sure, if you're trying to figure out your optimal entity structure, make sure you talk to your attorney as well as your CPA or accountant, so that you're paying attention to both sides of the coin, right? Which is asset protection as well as tax efficiency.
Now, as we come into getting your tax returns prepared, obviously another question we get around legal entities is tax filing requirements. So we talked about LLCs. There's options usually with an LLC. If you're the only owner of the LLC, typically it's going to be considered a disregarded entity, wouldn't have to file its own tax returns. The rental properties owned by that LLC would just be reported on your personal return. Now, if you have an LLC that the owners are you and a spouse or you and somebody else, there's options with you and a spouse. You could, if you we live in California, community property state, sometimes you don't have to file an entity return. Benefits of that is that it's cheaper and less paperwork. You might be able to choose to file a partnership return. Why would you want to do that as an extra tax return? Well, sometimes you might have better lawyers. There's lawyers that might feel there's better asset protection to filing as a partnership versus a disregarded entity. You might get better or less audit risk if you file as a partnership versus a disregarded entity. So there's pros and cons for sure.
Yeah, and you can make that determination now. If you have an LLC that's owned by, let's say, a husband and wife, oftentimes you can make that determination before you file your tax returns on which one makes the most sense for you. So definitely worth a conversation to have. The other common mistake we see, this is probably, out of those, another big one. I always want to say like they're big, but they're all pretty common, is the concept of depreciation and mistakes surrounding that. When you hear people talk about, how they make $300,000 of income and pay little to no tax using real estate, typically they're talking about depreciation, right? We're not actually losing money. Hopefully it's a profitable investment. But with depreciation, the IRS allows us to take a paper write-off on the purchase price of the building over time. So in a normal scenario, a $400,000 building can maybe generate up to, let's say, $10,000 of depreciation deduction every single year. And that is what we typically see when we review tax returns. But there are better ways to take depreciation, in which we call optimizing it. And so the IRS allows you to say, with this $400,000 building, it's not all just building, but we can do cost segregation. And that is to break down the components of what makes up this $400,000 building. And when we break those out, we can then take faster depreciation. So for example, instead of, on a $400,000 building, instead of $10,000 per year, we may be able to write off $120,000 in the first year, right? And this is where the One Big Beautiful Bill for 2025 and 2026 is so important, because not only are we able to accelerate depreciation, but we can take up to 100% write-off on some of those accelerated components. So as you can see, depreciation really allows us to supercharge the tax savings associated with owning rental properties.
Yeah, I think another tip too to be aware with the depreciation is, remember, the calculation of depreciation starts on your purchase price. It's not based on your down payment. So example, you could buy a $500,000 building. Maybe you get, with a cost segregation study, maybe you get $150,000 of depreciation. And maybe you spent $500,000, you bought it all cash, and you get $150,000 of depreciation. Or you could buy a $2 million rental building with your same $500,000 down, and you might get $600,000 depreciation, right? Same $500,000, but using the leverage and power of other people's money, we get a bigger depreciation write-off. And so that's where I think we see that mistake on tax returns, is that people just think, oh, I put 50 grand down, 100 grand down. That's going to be where I limit it. But that's one of the mistakes we see with depreciation for sure.
Yeah, it's based on purchase price. I think a common question we get is like, does it have to be a $2 million building, or can it be, 4 properties where the total purchase price is $2 million? Usually it's just based on purchase price, irrespective of 1 property versus 10 properties. But the biggest mistake we see when we review tax returns is just the depreciation not being optimized. The majority of returns we review, they're just taking regular depreciation.
Kind of like by default, right? Like whatever the system does.
Yeah. And I think there's a couple common reasons for that. One, probably accountants not understanding the whole concept of accelerated depreciation. We also have accountants who ask us, is that true? Is that valid? Why would the IRS allow it? I mean, that's just written into the tax code. So is accountant not understanding it, or just thinking that it's too expensive? This is something we hear a lot, where investors will tell us, well, my accountant said it's too expensive for me to take accelerated depreciation because I have to pay someone to do kind of a building analysis. But at the end of the day, it just, it's with any other decision, it comes down to what is the cost for me to take accelerated depreciation, and what is my expected benefit on that. Right. And so if your accountant is saying, well, I think it's too expensive, the follow-up question is, okay, well, what is it going to cost, and what is the projected savings? Because once you know those 2 components, you can then decide if you want to go ahead and do it or not. Right.
Now, going into tax time, really crucial for all you short-term rental operators, right? Don't forget about the furniture and all that other stuff that you're spending money. You bought the property. Maybe you bought a new property last year. And yes, you could look at doing a cost seg on the building and the property you bought, but don't forget about the furniture, the appliances, the supplies, all that other stuff that you're spending out of money to get the property furnished. All of that can be either expensed right away. Maybe you've got to capitalize and depreciate over time, but a lot of that stuff is going to be eligible for 100% bonus depreciation. So at the end of the day, if you spend $50,000 on furniture and supplies and getting it up and ready, you should be looking at it close to a $50,000 write-off for all that stuff. So I would be surprised if that was not the case.
And I apologize. I just realized we didn't move our slide. So we were still on the previous slide, but I went ahead and moved it now. Tax time to-dos. Okay, write this down. Send closing disclosures to your CPA or accountant. So purchase closing disclosures. Another mistake we see all the time when we review tax return, it'll say Main Street property, total purchase price, $350,000. That immediately tells us they did not capture all of the closing costs associated with property acquisitions, right? Loan costs. This is a very common mistake we see all the time. So as you're gathering up your documents, gather your closing disclosures on the purchase. If you sold any properties, don't just tell them I sold it for this amount. There's selling costs associated. Send them the sales closing disclosure. Refinance. If you refi the property, get lower rates, pulled cash out, make sure you send that refinance disclosure to them as well. Again, we don't want to see round numbers on a tax return, because that usually means you're missing out on all of the different costs that you paid for through closing of a property.
Okay, let's talk about the last mistake, and this is a big one. It's probably the most common and most costly, I think, for real estate investors, is not using real estate benefits correctly. So a lot of people, accountants included, don't understand short-term rentals. They don't understand first, what is a short-term rental loophole? Why do we call it a loophole in general, right?
Yeah, I post a lot about short-term rental strategy on my social media, and it's probably one that I get a bunch of random comments from, investors that say this is a lie. So
we call it hate mail.
I don't know. And so I want to make sure we kind of define what it is. So like Matt said, first of all, why do we call it a loophole? Okay, it's a loophole because the traditional investment in real estate are long-term rentals. And so historically, when people invest in long-term rentals, you typically cannot use the tax losses from, writing off your car, paying your kids, accelerated depreciation. Typically, those losses do not offset taxes from your W-2 income. They're what we call passive losses in the real estate world. And the only way for someone to use it to offset W-2 income is if they have a spouse who qualifies as a real estate professional. There's several different things you have to meet to qualify, but the hardest one for people to meet is they have to have more time in real estate than their jobs. So you can imagine, if I have a portfolio of long-term rental properties, Matt and I are both working full-time as CPAs, then neither one of us is going to be a real estate professional, which means all of those amazing tax benefits we just talked about, they are passive losses. And they basically will be used to offset taxes from passive income in the future, but not W-2 income. Okay, so a very hurdle for people to meet. Now, let's transition to short-term rentals. If you invest in short-term rentals, you do not have to be a real estate professional. Okay, so please write that down. You don't have to be a real estate professional if you invest in short-term rentals.
Yeah, short-term rentals can be a side hustle, right? And it can be a side hustle where you're working full-time, you and your spouse are working full-time, and you're still being able to benefit and take real estate deductions from depreciation and income shifting and other things like that deducted against your W-2 income.
Yeah. Now, there are hours to meet, so it's not magic. It's not like I own a short-term rental, therefore I can write off all of my W-2 income taxes. So you don't have to be a real estate professional, but you do have to meet what we call material participation hours. I know you guys probably have heard Brandon talk about this before as well. So material participation, there's 7 different ways to qualify. We'll talk about the most common 3, because 99% of people use one of those 3. The first one is you and your spouse, if you're married, you can combine your hours, and together you have at least 500 hours on your short-term rental properties. And that would be you staging the property, furnishing it, handling guest communications, dynamic pricing, all of the things, right? So 500 hours between you and your spouse combined, then you've met material participation, which means rental losses offset W-2 and all types of income.
The next test, so let's say you can't get to 500 hours for some reason. The next test is, did you spend at least 100 hours during the year on your short-term rentals and more time than any other single person spent on your property? So again, when we look at these tests, we're looking at you and the spouse. So if you have 120 hours, we look around and maybe you had a general contractor that helped on a renovation and they had 110 hours. Well, if that's the most of any other person and you've got more than 110, you've met this requirement. So that's another way. If we can't get to 500, we can look at using this test.
Yeah. And the third one is just basically you have more hours than everybody else combined. So the example might be, I'm the only person working on the short-term rental. I have 80 hours. And, if I added up the times of other random people that helped me, it was less than my hours. Then I meet material participation. And again, why is material participation important? It's because once I meet those hours, I can then use my short-term rentals losses, right, tax losses, to offset all types of income, W-2s, 1099s, business income, retirement income, crypto investments, stock investments, right? All types of income. And that's where we love to be, is cash flow positive, but create a big loss to offset the different types of income we make. But here's the problem. It is probably the biggest, or at least most costly tax mistake we see all the time. And the reason is because not all CPAs and accountants understand the short-term rental tax loophole. Okay, most people only know the tax law with respect to long-term rental properties. So here are some signs that you should look out for to identify if your accountant understands the short-term rental tax loophole.
Yeah, because we get this question a lot. It's like, well, how do I know if the accountant I'm working with understands real estate, understands the short-term rental loophole? But these are the things to look out for, right? So if you're talking about short-term rentals and your accountant's saying you make too much money to benefit from it, that's one sign that they don't understand it.
Right, because the short-term rental loophole works for people of all income levels. You could be lower income, middle income, very high income. There's no income limit in terms of who can utilize this loophole.
Next sign is the accountant's talking about you work too many hours to benefit from the short-term rental loophole. Again, short-term rental loophole, in order to utilize it, it looks like how many hours you spend on real estate. Doesn't matter how many hours you spend on something else. So again, you could be working a full-time job, 2,000 hours a year, and short-term rental could be a side hustle for you. And the third way that you kind of sign that your accountant doesn't understand it, if you hear them say that you cannot benefit from the short-term rental loophole because you are not a real estate professional, then it's time to find another accountant, because it's clear that they don't understand it. Because again, real estate professional is applicable for when you're investing in long-term rentals, has nothing to do with you're investing in short-term rentals. Completely different categories.
Yeah. Yep. Because we don't care about any of those things. We don't care how many hours you're working at your job. We don't care how much other income you make. Only care about how many hours you're spending with respect to your short-term rental property. So again, don't need to be a real estate professional to use short-term rental losses against W-2 income. You do need to meet material participation, being involved in the day-to-day operations of a short-term rental. In other words, you can have a full-time job, keep your career. Real estate could be a side hustle. You can strategically create tax losses to offset W-2 and other income. And so, for this works for all types of people. We have clients who are teachers, who are firefighters, accountants, right? Other accountants, physicians, social media personalities, athletes, celebrities, stay-at-home moms, stay-at-home dads, right? All types of people. And the key here is to make sure you earn the hours. So I'm hoping all of you guys kind of did that last year, because I know you guys, all own short-term rentals. But if you didn't earn the hours, then obviously we're in the beginning of 2026. Make sure you know the rules, make sure you have the documents, make sure you do it correctly. Because when we talk about short-term rental tax benefits, we're not just saving $1,000 or $2,000 in taxes, we're saving $10,000, $20,000, $50,000, sometimes $100,000 in taxes, right? So make sure you're doing it correctly.
And as you're going into tax season, right, maybe you're somebody, you're not sure if you met the requirements last year. Well, now's the time to go back and put together those time logs, right? Because if you get audited, that is something the IRS is going to ask for. They're going to show me your time log. And so you want to spend the time now to go through and say, oh yeah, I did meet your rule number 2. I did spend more than 100 hours. And I know that the only other people working on it were a gardener once every 2 weeks, or this person, that person. Now's the time to go through and do that. So if you are eligible to claim the benefit, you want to take advantage of it on your 2025 tax return.
All right, so we're gonna, before we go to the Q&A, we're gonna share a client case study, and we've changed the name of our clients to protect the innocent. So Scott is a teacher and Darla is a physician, and we wanted to share a case study of 2025. The reason being that 2025, as Matt mentioned, brought back the return of 100% bonus depreciation. And so this will kind of demonstrate the power of short-term rental tax loophole when utilized correctly. So Darla is a physician, and they had friends who invested in short-term rentals, got a lot of tax savings. And so, over the years, they've kind of wanted to dabble in the short-term rental space. But it wasn't until 2025 when they made the decision, like, okay, for sure, we are going to invest in short-term rentals. Now, they met with their CPA early in 2025 to file their 2024 taxes, like most people do. So not a surprise, they owe a bunch of taxes. Their combined income was over $600,000. They owed about $180,000, $187,000 to taxes. And that was fine, right? Not alarming. It's kind of what they were used to based on the income level. That's how much they lose to taxes. But what they were surprised by is their accountant calculated 2026 quarterly taxes for them to pay each quarter. And because Scott and Darla said, we are buying short-term rental properties, I thought that we could pay less taxes for 2025. So they were confused when they asked their accountant, well, why am I still prepaying so much taxes? Because I have short-term rentals that I'm gonna count on, right? And so let me show you what some of the items or the discussion points that the accountant told Scott and Darla in terms of why you still have to pay high taxes. So the first one is the accountant mentioned your income is too high to get tax benefits because you make over $150,000. At $600,000 of income, you don't really get to utilize any of the tax benefits associated with short-term rental properties.
Yeah, and they heard the same thing we were talking about earlier, right? Is you can't take benefit because you're not a real estate professional. You can't qualify as a real estate professional due to your jobs. Again, they're investing in short-term rentals. Real estate professional has nothing to do with that. Wrong advice, wrong situation for them.
Yeah. They talked about, writing off their car that they used as their short-term rentals were up in the local mountains. And so they were self-managing it. They were driving up to the properties. Accountant said, no, you really can't take a deduction for your car because of the fact that it's not in an LLC. And also home office, big audit flag, don't recommend you do it. Plus, not going to get much in tax savings, right?
Another thing their accountant told them is that they can't pay their kids because their kids are too young. Well, their kids are actually teenagers. Right? We're not talking about 4-year-olds here. We're talking about teenagers, where those teenagers actually are very useful, very helpful, probably know more about social media marketing than probably Scott and Darla did, right? And so that was a situation, again, where wrong advice, where they, something they certainly could take advantage of.
Yeah. And what's really interesting is they asked about whether they can do cost segregation studies, because a lot of Darla's friends who are also physicians did those same things and got a lot in tax savings. But when they talked to their accountant, they said, no, you really shouldn't look at cost segregation. Those are usually for large commercial real estate, apartment buildings. What you have are 2 short-term rental cabins in the mountains, and it's just basically too expensive. So the projected taxes that they were going to have to pay for 2025 was about $187,000 in taxes. Again, very similar to what they historically had to pay in 2024. So wanted to share with you guys quickly, based on the strategies of working with them in 2025 to reduce 2025 taxes, here are some of the numbers, okay?
So between the two of them, teacher, physician, they were making almost $625,000 W-2 income. Good money, obviously, right? They bought 2 short-term rentals in 2025, and they, spent some money on the furniture and all that stuff. They spent about $100,000 in furniture. They spent the time on the properties to make sure that they were doing what they needed to do to learn the business, manage the properties themselves to qualify to use the short-term rental loophole, increase their cash flow, benefit from the cash flow. So they made almost about $30,000 after deducting kind of normal expenses for the properties and things like that.
Yeah. One of the things we make sure we work with them on is income shifting. Like Matt said, they have teenage kids, and the family would frequently go up to the mountains. The kids would help out a lot. And so what they end up doing was paying their kids this pretty small amount of money, for the kind of stuff that the kids were helping them with. But it got about $8,300 of income shifting from parents to the kids. Small things, in terms of capturing car, travel, business development that they were doing with respect to their short-term rentals. Again, nothing crazy, didn't go out and buy a Tesla, but got about $6,300 of car and travel expenses simply by understanding what they can write off and what they can track, right? But here's the big one. We got cost segregation preliminary estimates for them, and we're looking at about $289,000 of first-year depreciation in 2025. Now, keep in mind, this is not commercial real estate. This is just 2 short-term rentals in the local mountains, a little bit over $500,000 of purchase price each, and that is the first year depreciation they're getting just on the building, right? So what we didn't add up here is like furnishing and all that, because we don't know what that amount is yet as of today. So these are just kind of the known numbers that we've received from the client. So you can see what happened was, by adding all of these strategies and stacking one on top of the other, their income went from $650,000, $650,000 all the way down to
just under $350,000, right? So we cut their income by $300,000 by utilizing strategies that are available to them that fit their investment goals, what they're trying to do to build their wealth, utilize the tax code to their advantage. And at the end of the day, it saved them over $112,000 in taxes compared to what they were going to pay beforehand. So going back, thinking about that, talking to their accountant, right? Oh, the cost segregation study is too expensive, right? Well, how much is it? Well, it's $5,000-$6,000. Well, it saved him $112,000. I would say that clearly and confidently that it was not too expensive.
Yeah. So again, if your accountant is telling you it's too expensive to do a cost segregation study, the simplest thing to do is ask a follow-up question. Can you let me know what is the cost and what is the expected benefit? Because then you can actually make an informed decision rather than just like a generic, oh, I think it's too expensive, right? It's only for big properties. So, a question we always get at this time is, how do I know if I'm overpaying in taxes? One thing you can ask yourself is, does your accountant talk to you more about what you cannot do versus what you can do? Right? We want to make sure we're working with someone who understands and can teach us on what are the things I can do to save on taxes. It's like when you're sick and you go to a doctor, they tell you what are the things you can do to feel better, right? They're not going to tell you, well, here are the things that you cannot do to feel better, right? So we want to get into a different mind space of what are the things that can be done. And it's really, really important that you are here today and you are understanding, or at least getting a preliminary understanding of what are just all the different things I can do to save on taxes being a short-term rental investor, because at the end of the day, no one cares about your money more than you, right? And that's just the truth. I mean, your accountants are busy. We're busy, we're accountants. So we always try to make sure our clients are empowered in understanding what are some of the basics things that they could be doing. If you want to know whether you might be at risk in overpaying in taxes, we've collaborated with Hospitable to put together a tax risk assessment. It is a self-assessment. You can scan the QR code and go onto the website. It's a self-assessment that you take, and it's a series of, I think, about 15 or 20 questions that covers your personal, investing, business, and investment aspects. And after that, you'll get a score. If you score high, great. That means you're ahead of most people we meet. That means you've taken advantage of some of the foundational tax strategies as a real estate investor. If you score low, that's okay too. That will be like most people we meet. But the good thing about scoring low is now you would know what is your risk in overpaying in taxes. You can actually print out your results. And when you meet with your accountant coming up soon to file your taxes for 2025, you can use that as a reference point to say, hey, I took a little quiz online and here are the areas I answered no to. Can we have a conversation about whether any of these are areas I should be taking a look at, right? So utilize, if we score low, that's okay. That just means we have a lot of areas for improvement as well. So let's head over to the Q&A and then we'll hand it back to you, Brandon.
Perfect. Okay. So we have quite a few questions in the Q&A. So what I will do is bring them up and then you can answer them. Some are very specific, but some are more generic. So let's see. Okay. So I know Aaron had brought up specifically the benefits of not owning any, but you do arbitrage, you do property management. And I mentioned, the difference between passive and earned income. So if there's any more you could share and shed light on property management as a Schedule C potentially versus that, I think that would be helpful there.
Yeah. So for arbitrage, rental arbitrage, basically, I rent space from someone else and then I rent it out. Usually we treat that as a regular rental property. So it's not on Schedule C, still on Schedule E, just like any other rental property. The main difference, instead of taking depreciation, I would take rent expense, right? Because I don't own the real estate, therefore I'm not taking depreciation on the building. I can still, however, take depreciation on everything else that I put into the property. So if I've staged it, furnished it, putting supplies and all that stuff, appliances, I am still able to take depreciation just as if I own the property, because that is money I've spent. So you still get this less powerful, but we still want to make sure we capture those deductions.
And for everyone else's benefit too, if you're running rental property, short-term rentals, you get to the point where you're providing what they call hotel type services. That's usually when we'll see the property being reported on a Schedule C instead of a Schedule E. Not the end of the world, but could be subject to self-employment tax if you're profitable, but you can still use depreciation to create losses. If you are profitable, though, one of the benefits of a Schedule C is it does allow you to utilize retirement planning options there. So you could have a solo K, SEP IRA, something like that you could take advantage of.
Yeah. Now, if you're a property manager, so like co-hosting and things like that, if you're acting as a property manager for someone else, then usually that is Schedule C income. So that's where, like retirement contributions and maybe we would consider a corporation because that's earned income. So maybe if you were a client, I would look at running numbers to see the cost benefit of remaining on Schedule C versus going to an S corporation to earn that income. So those are a couple of different ways to reduce taxes.
Perfect. There was a specific other one that's kind of tied to self-employment tax, which is a little bit tied to the Schedule E and Schedule C. So.
Okay.
So if a single member LLC, do you report STRs on Schedule C or Schedule E? Whether it's owned personally or a single member LLC, if you've got short-term rentals, if you're not providing hotel type services, which are like daily cleaning, food and beverage, room service, that kind of stuff. If you're not doing that, then your short-term rentals generally going to be on Schedule E. If they are on Schedule E, doesn't matter if you're spending 5,000 hours, they're not going to be subject to self-employment taxes. If you are doing hotel type services, putting it on Schedule C, again, if it's profitable, it would be subject to self-employment taxes.
Yeah.
Perfect. Great. So let's follow up with, so improvements. Do improvements include a new roof?
Yes, usually if we're talking about an entire new roof, it's usually going to be an improvement. If we're talking about fixing part of a roof, like I'm still keeping the roof, but there's components of it that I need for it to be fixed, then those sometimes could go under repairs. But if we're talking about brand new, usually yes, they're going to be considered improvements, which means instead of writing it off immediately, you would depreciate it over time.
And then in part of that, can I deduct rental income loss for the months my property is closed for improvements or repairs?
So that is a common question we get a lot. Unfortunately, the answer is no. But the reason being is that most individuals obviously are cash basis taxpayers. So you pay taxes when you receive money. If you never receive the money, you never pay taxes on it. That's why you can't take a deduction for it. So now you can certainly still, you're spending money on utilities in a certain month, insurance, property taxes, and a few months that you're improving the property. You can still write off those expenses, but the actual lost rent that you didn't quote unquote collect, that's not going to be a write-off for you because you didn't pay tax on it.
Yeah, the only very limited times when we see it being deductible is if you did pay taxes on it. So it's kind of like, hey, well, I reported, I thought I was going to make $1,000. I reported as income. I actually ended up not earning it, so I would write it off. So that my income is basically zero. But very, very rare in the short-term rental space to be on accrual basis of accounting.
And so we have a little bit similar tied to that, where it's specific to the property actually being rented out at the time of year and being able to write off a percentage. So I know this is a very specific question, but it's a little bit more based on if you're only renting out for part of the year, how much of an expense are you actually able to deduct?
Interesting. So it depends. It depends on what is the property doing the rest of the year, right? So if we're saying 2/3, 2/3 of the, well, I think to say from my own property for 2/3 of, So my property 2/3 of the year is a rental. The other third of the time it was in rehab, but nothing was being done. You can still write off the expenses because that's just part of holding cost period because guests can't be in there because I'm just doing all the work, right? So generally we still write off the holding cost even for that 1/3 of the year where nothing's happening. Now, if alternatively the other third, that's when it's not being rented out, if it's personal use, then no, you cannot write it off. Not as part of rental expense at least, because it's personal space for that period of time.
Yeah, I think it's going to come down to typically like a common example might be you lived in a house for 1/3 of the year and then you moved out, you rented it for the next 2/3 of the year. When do you deduct the expenses or what period does it apply to? It's usually going to be based on when you spend the money. So if you were living in the property and you paid for your insurance for the entire year, generally that's a personal expense is not deductible versus if you paid for it after it became a rental property, then becomes a rental property expense. So hopefully it helps a little bit.
And then we have a little bit on the short-term rental loophole in regards to that. So being able to use the property for personal use versus, average use for guests.
Yes, great. So let's define short-term rental. So for property to be eligible for the short-term rental tax loophole, the average guest stay has to be 7 days or less. Okay, so that's a hard and fast rule. If I have a property where for this year the average guest stay is greater than 7 days, not eligible for the short-term rental loophole, it becomes a midterm or long-term rental, which means I have to be a real estate professional, or myself would, to be able to use the losses against income. So as operators, we have, part of the planning on the tax side is to make sure we can control the number of average guest stays if this is a year I'm trying to use the loophole. Now, personal stays, if it would be like I'm there for the week or for the summer with the family, just having fun, to truly use the short-term rental loophole the way it's intended to do, your personal use should be less than 10% of rental days. And that's rental rental days meaning the days actually occupied by guests. Okay, so if my property was rented out for 200 days during the year, personally, I want my use to be less than 25 days, right? Less than 10% of actual rental days. If I go beyond that, that turns into my vacation home, which highly limits the amount of tax benefit that we can utilize. So very, very important to understand. Now, I will say we often have clients who are at the short-term rentals working on the properties. So if I have a short-term rental in Florida, we fly out there from California to work on the properties. Those are not personal use days. Those are days you're there working on the property. Okay, so those don't count against you if you're there working. But if you're there having fun, then that's a personal day.
And here's another tip too, because we see this happen. Let's say you buy a property midway through the year, and based on kind of, your planning, you are thinking, hey, I'm going to be able to utilize a short-term rental loophole this year. I'm thinking I'm going to benefit from a cost segregation study. From a tax perspective, it would behoove you to delay using any personal use days this year, because we want to maximize the rental days so we don't have to allocate any expenses of personal expenses. We can maximize our depreciation benefits. And then starting maybe January, February, you can use it personally for that less than 10% rule. That way you're kind of getting all the benefit or most of the benefits now, and then kind of start using your personal use later on. Another way to look at it.
Perfect. All right. So we have a few questions related to bonus depreciation, and I know for this year and 2026. So what are the benefits after the first year, after you've recouped the full bonus depreciation benefits in that first year? Basically, what are the tax benefits after the first year?
Yeah, great question. So I think it's a common misconception when we say 100% bonus depreciation. It does not mean we're writing off 100% of the purchase price of the building. So like in the example we shared earlier, it's a $400,000 building. I'm going to write off maybe $120,000 of it this year, right? So the remainder that I didn't write off, I am still taking depreciation on that over time. 100% bonus just means I have this building, I've broken it out into different components like specialty plumbing, specialty electrical, appliances, fixtures. Those things I can take 100% bonus on. But there's always going to be a component that's still the building itself that generally is still going to be depreciated. So those will be my future tax benefits beyond the year of cost segregation.
And then there was another one specific about 2026. So any new short-term rental purchased in 2026 is eligible for 100%, and is specifically a condo as well.
Yeah. So again, 100% bonus depreciation applies. It's not going to apply to the entire building. So generally speaking, there's going to be certain components of the building through a cost seg study. We call them 5 and 15-year property that would be eligible for 100% bonus depreciation. So anytime you buy a property for depreciation, we have to look at splitting the purchase price between building and land. Land is not depreciable, building is, and then we do a cost seg study and break down kind of the building into the different components. If you buy a condo, a lot of times a condo you don't own the underlying land. And so that's the benefit of a condo over sometimes a single family house is that, hey, I spent $500,000 a condo, all of it's going to be allocated to the building instead of $400,000 the building, $100,000 of land. So that's one benefit of a condo, or it could be a benefit of a condo. But yeah, certain components of the building certainly going to be eligible for 100% bonus depreciation.
Yeah, in 2026. So yes, if you bought something in 26, yes, eligible for 100%. And yeah, sometimes condos are even better than regular single family. But and that's part of the analysis too. For a lot of our clients, the tax planning comes in on the acquisition side. We had the client who made an offer on a property the other day. It looked really great. It was really close to the beach, and land was 95% of the purchase price. Can you imagine? That's almost no depreciation. So they walked away from it, and now they know, right? And now we're looking at other places where, maybe like a condo where it still could be, kind of like close to the beach, but the land value is much, much lower than 95%.
All right. So a little bit on top of that with capitalizing, are you able to capitalize the closing costs, or is it all just a write-out expense?
It's a good question. It actually goes back to kind of one of the examples that Amanda mentioned earlier is closing costs do need to be capitalized. So they need to be capitalized as part of the basis of property instead of being an outright expense. They're actually not eligible to be an outright expense. So what she was referring to earlier is we'll see a lot of times you'll buy a property for $400,000. We know that was the purchase price. And on the depreciation schedule, it's got building and land that adds up to $400,000 even. that's a dead sign that they missed the closing costs. So maybe they expensed them incorrectly outright, but more times than not, it's just didn't even take into consideration at all. And so you want to make sure you're adding that to your basis so you're getting the depreciation benefits over time.
Yeah.
And then this may be a little too specific, but you may be able to help specifically with properties that are outside the U.S. if that applies at all. I know that's kind of very specific, but just wanted to add in case.
Yeah, good question. And again, this is where tax planning happens before you buy a property, right? Not at tax time. The issue with foreign properties is that they are not eligible for bonus depreciation. The depreciation is on a different method. So any property located outside of the U.S. is not eligible for accelerated depreciation, which also means it is excluded from 100% bonus.
You can still depreciate it. You just can't take the you can't
fast.
supercharge. You can't take it fast like we're talking about some of those other STRs.
Yeah, and this is true even though you live in the U.S. It's looking at where the property is located.
Perfect. Awesome. And then this is specific to solar and short-term rental. So putting Tesla solar on their house, can you claim that as tax credit? Is that available? How does that work?
That's a good question. I've not looked at solar for 26 yet. My understanding is that solar is not available for 2026, but I'm not 100% confident on that. But
yeah, it may not be available as a credit, but let's say you spend $50,000 on solar panels for your short-term rental. That would be an example of something that could be depreciated. It's usually a 5-year asset, which again means it's eligible for bonus depreciation. So the $50,000 cost could be expensed basically right away. But obviously, we know an expense is not as good as a tax credit. So that's the only. I think Amanda's right. I think there's something in the new law that kind of limits solar or energy credits going forward.
mm-hmm.
I've heard this one quite a few times as an owner as well. Is there a higher audit risk for utilizing the short-term rental loophole?
Yeah, that's such a good question. I know it's top of mind for a lot of people. At the end of the day, our firm, most people we work with own rental real estate. A very high percentage of them own short-term rentals, use the loophole, use all the stuff we just talked about. And the percentage of returns that are audited in terms of our client base are very low. I think out of, let's say, 500 clients that we work with per year, I would say less than 3 are audited. And what you might find interesting,
she just jinxed it, right? But
oh no. But it would be interesting for you guys to know that a lot of accountants talk a lot about audits, and I really, they kind of use that as a scare tactic, right? Oh, don't claim a home office, you'll be audited. Don't do cost segregation, you'll be audited. Don't do short-term rental, you'll be audited. But the reality of it is, the times when our clients are audited, it's not actually because of short-term rentals or depreciation or any of these things that people talk about. It's from simple things like 1099s not matching. So for example, Airbnb issued a 1099 to my personal name, but I reported it on my LLC tax return. Now I'm personally being audited because they're trying to ask me, where did that money go? How come I didn't report it? And this is a great tip. I'm glad somebody brought this up. This is so important that we tell clients all the time, I want to see all of your tax documents. I want all the 1099s, 1098s. I want to see it all because I want to make sure that what the IRS received from all those vendors is how we're reporting it. And if they're wrong, we go back to the vendors and have them correct it. Because 9 times out of 10, audits are not because of you using one loophole or another. It's usually because of document matching, because they have computer systems that do that, right? So something very, very important for all of you guys to know and do right now. Don't forget little brokerage accounts you forgot about. They issued you something, report it.
That third job that you might have had for like 12 hours during the year, don't forget about that.
Yeah, but very low audit risk for rentals. And just to round out this question, the whole reason of doing proactive planning, right? Meeting with your accountant during the year, figure out what can I do? What should I do? How should I document? The whole purpose of that is for audit protection. We want to make sure we're doing the right things during the year. We want to document things the right way so that if I'm audited, I'm not stressing about it because I've done all those right things that the government wanted me to do, and I can support that I did those things.
Awesome. We have a few more questions if you guys still have some time. I know we're right at time, but if you're free, we can keep going with a few more if that's okay.
Yeah, we have a couple minutes. Does it say we have
Perfect.
147 questions?
No, we have like 3 or 4, so you're okay. And some of these are
Just
a little bit
looking at this
easier
little
to answer.
bubble.
So yeah. So for example, like when you're having to track this, what would you recommend using, and how would you track material participation?
Yeah, what we tell clients is you definitely want to track it. Best ways we found to track it is use either Excel. If you're somebody who likes using Excel, you can get a template where you're tracking a description of what you did, number of hours, the date, the property address. Or if you're somebody who likes to use apps, there's definitely apps out there. Reps Tracker is a good one. REPS Tracker. It has a component for long-term rentals, also has a component for short-term rentals. So just use the method you're going to stick with, right? Don't start with Excel and switch over to app and switch back to Excel. Like it gets messy, right? Find the one you're going to stick with and go with that.
Perfect. And then falling into a little bit more of tax write-off, travel costs. I know that's a big one. Being able to justify the cost of your family, even though you're the manager of the short-term rental, how does that work?
Yeah, I mean, that's, a little bit of a pre-planning beforehand, right? So if I'm going to Florida and I happen to look at some open houses, I don't care what you hear on TikTok, that's not a tax deduction. So you can't just be somewhere and happen to pick up some flyers and write everything off. But what we can do is before we go to Florida, make sure we have predetermined business activities scheduled and set up. So I'm going to meet with a local realtor down there. I'm going to work with look at some property managers, meeting with lenders, and having documentation of those things. Now, if I'm there, I do those things. I happen to want to go to Disney World on the weekend. Great, that's perfectly fine. But it allows me to deduct the travel and all those different costs. Generally, you as the investor and a spouse, if you're married, usually both of those people are the decision makers. They're deductible, even though you might be the only person on title or you might be the only person doing most of the work. So usually the spouses are. Now, for the kids to be tax deductible, the key would be to figure out what are the business purposes of your kids being there, right? Are they doing your social media? Are they able to help you to take pictures or analyze things? And obviously in that context, the older they are, the more they can do. Just because you need babysitters or you need childcare while you're traveling and you have to take the kids, unfortunately, that alone is not business purpose. I know we have a lot of clients ask that question. So trying to figure out what are the things that your kids can do while they're there, right? What's the business purpose of them being there?
Perfect. And then this one, I'll kind of adjust it a little bit. We have like 2 more, but basically, what are any specific tips? Because different state level, of course, is different. And in Missouri, we do capitalizing versus a different state. So, is there any specific tips you can share that are just general across the board that may help?
Yeah, I mean, I would say for short-term rental investors, make sure you track all your expenses. Make sure your properties are held in the LLC instead of, corporations. I would make sure you understand optimizing your depreciation. A lot of times clients will tell us, my CPA understands real estate, they understand short-term rentals, they own rental properties. And then when we review the return, we find out, oh, they didn't actually do those things that you thought they did. So one quick thing you can do is you can just ask them, right? We just want to ask better questions. Instead of saying, oh yeah, did I take cost segregation on my properties? A better question is, how much did cost segregation save me on my taxes for 2025? How much did buying that short-term rental property save me in taxes last year? Right? So then you actually have a number to attach, and then you can verify whether something was done or not. Those are just kind of at the federal level. We do work with people all over the U.S. in different states. And from a state level, unfortunately, it's not something that could be answered because every state is like its own little country.
But I think worth mentioning too is there's certain states like California is one that doesn't recognize bonus depreciation. So you can still utilize a short-term rental loophole. You may get less deductions at the state level, but remember, just because you live in California, filing a California return, you can still use bonus depreciation on your federal return. That nothing changes there, right? So, maybe a different benefit on your state return, but big picture, obviously, everyone pays more taxes, federal taxes, than state taxes.
And then finally, about Keystone, does Keystone also do filings?
Great question. So yeah, we're a traditional CPA firm. So we do kind of all the usual tax return filing, tax planning, bookkeeping. But we are of the firm belief that true tax savings only comes with tax planning. So although we do offer tax return filing, all clients who come to us are here initially for tax planning, right? It's really about and I know today we talked very specific about short-term rentals, but from a planning perspective, the fun things we get to do is to go beyond just short-term rentals. We look at a person's entire financial profile. What kind of income am I making from my W-2? Where my retirement money? Where my brokerage money? And how do I effectively put all those to work for me so that I'm able to save on taxes and maybe scale the portfolio faster as well. So that's the kind of fun stuff that us nerdy people like to work on.
Perfect. All right. So let me get off the Q&A maybe. Well, hold on. I'm usually pretty good at getting rid of this, but I can't get it to go away. So okay, there we go. Okay, perfect. So just wanted to thank Amanda and Matt for joining us today and helping. So there's more that if you want to continue the conversation and get some materials or anything and have any follow-up questions, feel free to use the community and share the QR code and you're able to scan in there. And then of course, this is also going to be recorded and it's going to be posted like Petra mentioned. And then again, in I guess 2 weeks from now, we will have another short-term rental, very, very general. And so it's going to be more based on income, expenses. What is income? What is an expense? Can kind of walk through kind of the baseline of getting ready to starting your accounting journey with short-term rentals. And then 2 weeks from there, we'll be talking about everything the Hospitable offers and time for that. So I think that's all that I have. And I just want to thank again, Amanda and Matt for joining us and very much appreciate everything and all your insight today, guys.
Yeah, thank you so much for having us.
Thanks, Brandon. Thanks, Petra. Appreciate it.
Awesome. Thanks, guys. Have a great one.
Bye.